Welcome back to Main Street Meets Wall Street. We're broadcasting from the Wall Street of the South, right here in Charlotte, North Carolina. I'm your host, Marcus Durbin Sr., owner of the ABC Square Financial Planning Firm. I'm going to start today's broadcast with a raw dose of reality. No one's coming to save us. Not the government, not your employer, and certainly not Wall Street fund managers who collect management fees whether your portfolio goes up or down. This broadcast is for every working American, retail investor, and household CFO who is tired of relying on default. If you have a 401k, an IRA, or a paycheck you're trying to turn into long-term generational wealth, this broadcast was built specifically for you. Oh, and guess what? We have a very large international audience as well, so this is a global advice, not recommendations. Today, we're running a streamlined how value to show you. First, we're going to start with a market blitz, where we'll cover macroeconomic forces impacting your money right now. Fed Chair Kevin Warsh's interest rate tightrope, Middle East oil shocks, and key stock realignments such as Apple and Intel. And then we're going to dive into, coming straight from a question, what did people do before 401ks? For those who don't know, 401ks didn't come about until like 1978. So we're going to have to stop running your financial life on autopilot. You'll understand how to capture 100% of your employer's 401k match, how to audit some of these expenses and stop those fees, build you a multi-bucket wealth strategy outside your job, track your complete household budget in real time. So hit that like button, hit the subscribe button. You can drop your city, state in the live chat right now. We're going to get straight to work. I want to just take a second, like I said, thank the folks who are joining us, checking this out live, wherever you may be watching from. We have a pretty broad audience checking us out from all over the globe, actually. It's very humbling, and it's just great to see people checking us out from all over the globe. Thank you so much for what you do and how you join in and check us out. So let's just jump in. Let's talk about what we got going on right now, right? So we have Kevin Warsh coming into his next meeting, one of his next Fed chair meetings coming up Wednesday. The market is not really giving the meeting room to lower rates or raise rates. The market and the data is kind of just leaving it, maybe data dependent, but Warsh has already said that he's approaching the Fed different. So it'll be interesting to see his remarks, how long his speak is, how long he speaks for afterwards, his speech that he gives, whether or not they actually raise rates. I don't think that'll happen at this meeting, but that's been the odds of hikes continue to go up. I saw an interesting poll, or I saw it. Yeah, it was actually a poll, interesting poll showing the odds of hikes. So one of the odds of hikes, it was up at like 81% for a hike by July of 2027, but it only went to like 82% for a hike by the end of 2028. So like 6 months, if they're saying if it doesn't happen by July 2027, then it's a 1% chance that it happens. But these numbers have changed. Like I said, these numbers have changed right over since Warsh has taken over. If everyone remembers, when we started this year, everybody expected lower rates from the Federal Reserve. Everyone expected Donald Trump's new chair appointee to come in and just lower rates as soon as it happened. We knew Chairman Powell's term was expiring, and the Fed, frankly, just hasn't reached their target since, for like 5 years. They keep saying 2%, but they have not reached that 5% or that 2% goal. So the Fed struggled to reach that goal. I don't even want to say struggle. The Fed's just failed at reaching that goal, right? In the current environment that they're in. And after that, we have record levels of debt, and servicing debt. Our serviceable debt's like $160 some odd trillion plus that we have to service. Well, our national debt's approaching $40 trillion. But when I say serviceable debt, and if you haven't seen it before, if you look back in old videos, you can see where we're talking about serviceable debt and just the debt. There's a great video on debt, actually, that I did with James Callahan, where we're talking about debt. But with the debt, he's down national debt. He's a credit analyst. He was a former credit analyst. He's retired from that now. But he saw a lot of things. So with the debt, what do you see inside the debt? And then how they can manage the debt. Headline inflation remains sticky due to these energy prices. We see the fluctuation, right? So we have the war, which could actually provide some shield maybe for Warsh to cut. But while the obligation to service it just continues to go up. So we stay at these interest rate levels. So Warsh is boxed in, cutting those rates too fast could keep this economy running real hot and actually increase inflation. But keeping rates elevated with sustained pressure, that could slow down growth, which I don't think Warsh wants to do. There are other tools Warsh could take. He could look at quantitative tightening or easing on the actual balance sheet as opposed to rates, money supply. There are a lot of different tools that the Fed actually has. And then they have Fed speak, especially when you have a Federal Reserve chairman like Warsh, who said he wasn't going to speak a lot. So his words presumably will move markets more than what people are generally anticipating from the markets right now, or maybe even what Chairman Powell did. We've noticed also when we talk about people and not moving the markets anymore, the president's tweets and posts have started to have less effect and impact on the markets now. Every post and tweet, especially when it comes to the war, which we'll get to that in just a second, Iran war and some of the geopolitical issues they have going on there. But like I said, just want to stay with the interest rates and debts right now. For those, just a brief reminder, where we look while we're looking at this debt, because as the interest rates rise or if they go up or if they go down, I think they probably will stay the same at this next meeting, as I stated earlier. But that's a double-edged sword, right? If they go up, the amount of money that you're earning on your savings increases, right? But like I said, the cost of services debt for the government's going to increase. If they go down, it'll be cheap for the governments to service their debt. It'll be less money for individuals inside of their retirement accounts. For individuals inside like high yield savings accounts, those will go down because those kind of attract to the markets and the Federal Reserve rate that, they got the spread inside there. But so if it goes down, it ideally is better for the government to service the debt, but it's worse for, let's say, like retirees, people who are retired or set on some type of fixed income rate. Unless your income rate was based on like the COLA adjustment, it goes below that, which it won't. It rarely does. But that's just some of the ways that, the debt and interest rates impact you every day. Also, not to mention just personal borrowing costs when you go to borrow money from anyone or anything. They usually, especially banks, lending facilities, they're going to anchor onto the federal fund rate and then add their costs on top of, because, of course, they're going to have to make a spread on top of that. The banks just aren't going to let you make all the money per se. They're going to want to see their spread. Another thing is with Chairman Warsh, he announced the personnel for his task force. We've talked about that in past videos before. We've had some pretty deep dives on Chairman Warsh and his Federal Reserve Task Force. But one is going to be communications, balance sheet audit, economic data and sources, AI productivity and framework, and then inflation 2.0. But like we said, when he mentioned inflation, he put it as a look to the left of the decimal. So he's looking at the whole number to get down to 2, maybe not the number on the right of the decimal. So maybe not maybe 2.9 is 2 to him is what I'm saying. So he's changing it from that side. So it's a big shift. You also have to remember that Jerome Powell is still on the Federal Reserve Board. So Powell's still there. He's just not the chairman anymore, but he's still a voting member, if I remember correctly. So Powell's still there. Warsh is trying to find his feet. Most new chairmen have been tested in history. And another thing, new chairmen have pretty much in recent history all had to make their first move a hike. So we'll see if Warsh somehow navigates a position where it's not a hike from his end. But from what we've seen in history, in recent history, the first move is usually a hike, where there's usually some type of conflict. So, and then, speaking of conflicts, we have the Iran conflict going on. Oil prices spiked again last week, back around 100, up over 100, but with the delays or the pause in the kinetic warfare, USA stopped bombing Iran for a little while. Last few days, that could pick up any time, but Central Command didn't announce any new bombs flying over there. And the Strait of Hormuz, like I said, that's been pushing oil prices higher. So it's definitely had an impact on the stock market. As we've seen oil prices go higher, we've seen the stock market go lower. And then today we saw oil prices retreat and go back down. And we saw the stock market in turn go higher. Stocks were higher, much higher this morning. And then that kind of reversed. Like futures were way up this morning for the stock market, which is another thing to see. Like futures are just all over the place. The stock market. So this higher energy, like I said, that translates to everything. It costs more for people to transport stuff. It costs more for people to do anything that they want to do in life, because it's the transportation cost always comes back down to that's input costs that people are not accounting for, but the manufacturers account for. We've noticed PPI has been higher than CPI here lately. So that means, producer price index versus the consumer price index, that just means that the producers are still eating more at the cost for now. We're seeing tariffs come back into play, like at a higher level or more sustained level, I should say. We saw last week of tariffs. So that goes into geopolitical play. I juxtapose with the tariffs that the level of tariffs definitely matter, like whether they're like a crazy, crazy high level, but like the fact that we have tariffs wherever we have them at, like some level of knowing what tariffs matters as well. It may even matter more, because corporations, businesses, they adjust to these things, right? They take their time and they figure out like these big moves. And large money like that institutional money, they don't move as fast as retail investors anyway. So it'll be interesting to see if we continue to see these increased input prices from the Iran conflict that's happening right now. We'll see what happens. We'll see if we can get another memorandum to continue this ceasefire. I don't know if it's ceasefire. I don't even know the technical term they're using right now for when it changes, the reason that we're at war changes. But there's just a lot going on over there in Iran right now. Thoughts and everything for our soldiers, the people who keep us safe, and we lost a few more soldiers. So hopefully this conflict ends soon and we can get back to worrying about the normal stuff. I say normal stuff, what people know worry about with stocks, prices, earnings, all those things that are going on. Speaking of earnings, we're gearing up right for earnings season. So a big earnings season ahead of us right now. We're actually in the midst. We're about to hit the biggest part of it. We have some of those mega cap companies reporting, some of those hyperscalers in the AI build out. Will be interesting to see what they say. I think Google reported last week. Google reported, and when they reported, they let the world know they're still going to increase CapEx because they see CapEx and AI build out as something that is almost insatiable. You know, they can't not build to keep up with it. Otherwise, they will be behind. And it makes sense if you listen to what I just said, like break it back down. But the hyperscalers in the build out, and then we had Anthropic and the Hugging Face, where one of the models went in. They set up the model to attack the cybersecurity, but based on some parameters, and then the AI model decided that it would just go in, I think, down to the root source to the test and figure out how to get the best answers, like the most efficient answers, and end up like hacking deeper than they even anticipated. So that type of stuff's worrisome, you know, a little bit when it comes to AI. But we see some of the AI companies right now actually coming into a consortium where they're going to look to curb and model their AI output and what those models are doing. But who knows, man? Those models are smart. You know, they're already running and generating. I don't think they're showing us everything they know anyway. But I'm not going into conspiracy theories here. We're just talking about like actual input. So it'll be interesting to see where people are at with what hyperspellers are saying with their capex when it comes to AI and the AI build out. How much money are they spending? Will Google be a canary in the coal mine, or is there a lot? Are we going to see people who can't meet their debt? We also saw Nvidia today come out with more backing for, I think it was Anthropic. They said they were going to back them longer with like $250 billion worth of credit, extend to 250 million, 250, can't remember if it's billion or million. It's a big number though. I have to look that one up for you. But it's a big number. I think it's billion. $250 billion. No, it's $250 million. $250 million investment. So kind of like a credit type investment if someone needs it, but it's actually coming from NVIDIA's credit sheet into their free cash flow. But the way it's set up, I mean, the company you're financing has to reach certain tranches for it can even access the credit. So they have to reach certain goals and certain parameters. And you just want to think that people are back to the circular investment. NVIDIA is inside of everything, and it always goes back to NVIDIA. But NVIDIA was down today. We've seen semiconductor stocks come down, the software stocks have risen. Big thing that we've seen here lately in this market is we've seen the broadening of the market. So while you may look, and if you've been heavily investing in tech, like you've been too heavily investing in tech, and you look at the market now, your portfolio is performing a lot worse than if you're more diversified right now. But for the past 3 or 4 years, your portfolio is probably outperformed. It's not probably your portfolio has outperformed an equal weight index, but we see the RSP, once again, not stock recommendations, just the equal weighted index. We see that starting to outperform some of these cap weighted indexes that show like, you know, the concentration to the tech sector, to the AI build out. So when I say equal weighted index, that just means whatever number of stocks are inside the index, if it mirrors the S&P 500, take the number, you divide it equally into the number of stocks, and that's equal weighted. Whereas when it's cap weighted, that's more of like how much the actual market capitalization is of the stock. So if the stock is like NVIDIA, you know, NVIDIA was what, $4 or $5 trillion. So it was more of the market cap than say at the time, just think about it, Intel, even though Intel's had a run now, but like when Intel was a much smaller market cap. So it didn't weigh as much inside of it. Whereas, so like the Mag 7, which isn't really even a thing anymore, while it was a big thing, still going, it got up, even at the beginning of this year, it was like 35% of the total market cap weighted, right? So that's what it made up from the market, those 7 stocks. And the rest of the stocks in the market, the rest of the 493 made up like, you know, 70% divided however they were weighted. But the equal weight stock markets are, so you take those and then you just take how many stocks you have and divide it equally. So when you hear people talk about cap weight versus equal weight, that's just kind of what you're thinking. Right now, equal weighted stocks, the equal weight stock index is outperforming cap weight. We're seeing rotation, so a big circle, secular rotation, that we're seeing right now for the tech into like healthcare. We're seeing some of the beneficiaries of AI build right now. People want to see what's happening with AI. So we're seeing the beneficiaries continue to grow from this right now. We've seen healthcare grow. People are seeing innovations inside of that. Industrial. So as the build out continues to go, financials that finally come to life. Someone has to finance this building. We've seen the IPOs. I did live videos on SpaceX and IPOs. So if you want to check those out, check them out in the description. Just go to the channel and check them out. But we've seen a lot of those as well. And so while the reason the banks are earning a lot more, or you see them finally making it, like I said, with the AI build out, they finance these things, they give people debt. Once again, they're financing at whatever the Fed fund rate is, plus their spread, so they can make their money. Then even if it's coming from a corporate type of debt, so like junk bonds or spread, when people talk about spread is, let's say you have, let's use Oracle. Oracle's issuing debt. Oracle's a big name right now for people. Oracle's had terrible, terrible years since its highs. It's well off its highs. It's almost 300, above $300 now. Oracle's barely $120, somewhere in that range in like less than a year. But a big part of that is because of the debt and the way that Oracle is building out their facility, and people are worried about the Oracle debt build out. How is Oracle building that out, and what is the spread? What are people willing to pay on top of that? So let's say, and I think right now the 10-year bond was, last week, got to like right around 4.7%. So the spread on top of that, let's say Oracle, and these are hypothetical numbers for Oracle, whatever their debt spread is, or any bond when you talk about the spread. So it would be the 4.7. Let's do easy math for me, a simple man like me. Let's say 4.5 for the 10-year treasury. And then let's say you're getting a corporate bond. And the reason you need more money is because it has more risk, right? So the United States has never defaulted on its bonds yet, or any of his debt, knock on wood, has yet to default. We've yet to not pay back anything. So you get the full faith and guarantee of the United States when you, or whatever that means, whenever you invest in a paper like U.S. paper treasuries, it's anything like under 10 years, right? So when you're investing inside those, but even if you're investing in something lower than that, it's just not called paper. But you get the faith of the U.S. government. So that should in turn require a lower rate than if you were investing in a company that may go out of business or may have a higher risk of not being able to pay you back. Obviously, then the U.S. government is going to have a higher risk of not paying you back. Any corporation in general would, because USA, especially the way it's set up now, like the government's set up like a big corporation. But when you have those type of things in that setup, so the spread should be how much risk you're taking, right? How much extra do you think you should get? How much juice you should get for the squeeze per se, right? Do you think Oracle's extremely risky? Should you get 2 or 3% on top of it? Once again, numbers that we're talking about arbitrary. This is more for purposes of just speaking and educating. Yeah. It's been a while, folks, since I sat down and just gone on tangents and spoke the Main Street. So yeah, I just really appreciate everyone who listens, everyone who's joined, everyone who subscribed to the Main Street Meets Wall Street podcast. Like I said, this thing is global. It's like 20 some odd countries that have listened to this, maybe even more. I should pull up and show the analytics. And what's cool about it is like only half of it is United States. So it's really like going around all around the world. People are listening to it, checking out the podcast and the show. So we really do appreciate that. The Wall Street South Journals, it's over 1,400 subscribers right now. That's a monthly newscast, monthly newsletter that we put out over there from ABC Squared, straight out through my LinkedIn page, Marcus Durbin Sr. So we put that out. And then, like I said, this channel is just growing. So thanks for watching, everyone. I do really appreciate it. Subscribe, all those great things. But there's still so much more to go. And it's just been a while since I've taken time to just sit back. Thank everyone taking time to just reset the channel. People wonder what we do, who we do it for. Do it for y'all. Do it for Main Street. People are talking about what is this about? Why are you doing this? If you want to go back and listen at the very beginning, some of the early episodes, we talk about that. Why we're doing this. Just want to help educate people who, and I don't want to say they don't understand or they just don't understand. It's conversations that we don't have, conversations that we didn't have growing up at the dinner table. That's why I sit here at the dining room table sometimes and have these conversations with y'all. Folks, you come into my home, we can sit here and talk about these things, and just figure out what Main Street needs. That's how part of this episode is going to come up. We're going to go to the back part and we talk about the history of 401ks. This was actually someone who reached out and said, hey, so something you should elaborate on this. I think more Main Street wants to hear, and I was like, I got a whole lot of hours. People could find it, but no. Main Street Acts, I'm going to give it to you. So at the end, we're going to talk about 401ks and like the history of them, how they weren't there before 1978. So that'll be a cool conversation. All right, I guess it's a monologue. All right. So Apple, I want to dive into Apple actually. We want to talk about, before we dive into Apple, with these geopolitical conflicts going on right now with the midterms happening right now. We have House of Representatives going on recess. The Senate, will see whether they go into recess or not. There, some people are pushing for them not to go into recess. We'll see. But when you have these type of things going on, you're going to continue to see the stock market be extremely volatile and choppy. I think we'll see some more clarity once we reach the midterms and toward the end of the year. But even in like the last month, we've seen the volatility of the VIX index raise, several percentage points. So not just like little basis points, but like big whole percentage points. So we'll see some more volatility as, we're literally in a war right now. So when you're in a war, you can see different type of volatility. We saw Ukraine possibly getting involved, so it's expanding outside the region. They're saying that Russia's helping Iran with satellite imagery. There's just a lot going on. Hopefully, this conflict is over sooner than later. We've been going since February, so here we are. February to July, we're 5-6 months in. February to July, that's 5. 2 to 7, that's 5 months. So we're a little over 5 months in right now. So hopefully, this conflict can come to some resolution. Apple. Why does that say Apple victory lap? Call back in January. It's very funny, man. The mainstream and the fancy folks, they see these things, they call them, and you hear it. All you're hearing about right now on the news or wherever, if you listen to economic news, how Apple's the winner, Apple's this, Apple's that. And Apple does have a nice runway right now to be the winner. They don't particularly have anything to impede them. I think the next big challenge they may have is in September when Tim Cook steps down and the new guy steps in, right? But it's all over financial media, financial literacy, or financial media, financial news. Apple's going to be the winner because Apple's native to most people. Half the world has iPhones, the built-in system. When's the last time we haven't paid a subscription fee? But why I giggle, or I didn't giggle, grown men don't giggle, I guess, but why I chuckled a little bit at the beginning when I said this is because this Apple conversation that's going around right now, we literally had this conversation on 3 Pro K TV in January with live audience in Vietnam, like I said. So the question they asked me was Apple or Google, right? And once again, I don't think, especially if you're a long-term investor, like you're not going wrong with either of them. But, they made me pick one. So I picked Apple. And this was at a time when Apple was way down. Like I said, it was January. Apple was down. Apple and Google had just announced a partnership. And that partnership, actually, Apple is paying Google. So it's like, people are like, but why are you saying Apple? And I'm like, Apple. And I'm sorry, folks, let me make sure you all realize this is not a recommendation for any stock. Everyone's individual investments are different. Everyone needs to approach them individually, So this isn't an individual stock recommendation for anyone. This is just the case I made for Apple, and just want to elaborate that this has happened before, right? And I shouldn't say victory lap. Maybe it should say humble brag, or maybe it should just say the fact that Main Street has a lot of information that, we're giving it to you from here, right here. This is an outlet for you all. You need to share this with people. You need to let people know, come check it out, man. No biases, no political fronts here. If we're going to bring something to you, we're going to give you both sides of the story, you know what I mean? And hopefully you can make an informed decision yourself. Like I was saying in January, so Apple, I said, you have the whole built-in system with Apple, you have the services. Because I was thinking, like, when's the last time I haven't paid my Apple services fee, So you have these things coming in, they're just built in, people are going to get them. And Apple keeps messing up, Apple keeps not quite getting it right with the AI build out, and people, part of the reason everyone was saying, Apple is not spending any money on AI, on their AI build out. And I'm like, and I don't want to sit here and make it sound like I was the first person to say this, but I was one of the earliest people to say this, I feel like, And you can go back and even look, like, when I did stuff with Samuel Brink from Business Insider, I think I told him, like, Apple's a stock you want to pretty much just hold, But I said, so Apple has the native environment, and it always comes back to Apple. Apple doesn't have to be the first one, right? So the early bird gets the worm, but the second mouse gets the cheese. Apple gets the cheese, right? You know what I mean? Like, Apple they don't even have to be second. Apple be third, fourth, but generally and usually once they've taken that time, Apple's going to do it right. So like Apple will have the best version of it. And then if it's not correct, they'll figure it out. Now, they have definitely struggled with devices here. Some of the things Apple has done, the software, the music, Apple is innovators. It'll be interesting to see what can happen. Apple's been going up in this market when everything else in the tech world's been going out. Once again, Apple took a lot less with the CapEx. So they have more money that they can spend in CapEx right now, but we'll see if they do. We'll see what they say. Apple reports soon. So Apple, just part of this mega cap earnings season that we're in right now. Earnings season's actually gotten off to a good start too, but it's projected to be a very strong earnings season. So it'll be interesting to see what Apple has to say. This is getting close to Tim Cook's last earning call. I think, yeah, this might be Tim Cook's actual last earning call. Yeah, I guess this is his last earning call if the new guy takes over in September. Yeah, he might be on the September call. But anywho, so Apple, like I said, Apple's native. If you worry or you're wondering, just think about last time you didn't do whatever you did with Apple. I know half the world doesn't have Apple, and a lot of people don't like Apple stuff. But Apple's ingrained in a lot of things, and Apple's actually now making moves with their AI. Once again, not stock recommendation, just conversation, just something that happened back in January, you know. And now people are talking about it in July or in June and just, oh, Apple, right? Another thing that we're talking about, way back when, once again, these are not stock recommendations, but Intel. Intel was a stock that I was talking with Samuel Brink about. So when I was talking about, people want to know like my opinion on stocks. You can find it. It's printed in the media, right? It's like, so those are like, and those aren't recommendations, but those have more of a thesis behind them that I've written out or elaborated in there than I really am going to go in with these videos because I could go for a long time on each one of these. But the Intel was at $20 at the time. We've seen Intel rise to like up over 120. It's back hovering around $100. One of the things at the time was the government was bent on making Intel America's chip manufacturer, right? As part of the AI build out, Intel was integral to it. And then we saw, so even in the Biden administration with the CHIP Act, we saw a commitment to building chips in America, foundries, we want to build foundries. Intel just seemed to keep messing up, tripping over their own feet. Intel finally switched out CEOs. They got a new CEO in there. They started the turnaround project, and also the government took a 10% stake in Intel. But that 10% stake was, like I said, at like the $20 level, and Intel stock has since soared up way over $100. Intel just had their earnings call last week. Intel reported pretty strong quarter as well, and they like their projections and their forward-moving guidance for Intel. So Intel is another one that we were talking about a long time ago, but people have been speaking about here recently, like once it jumped to, because when it jumped up to 100, it jumped. Like it made moves, jumped in tranches, but when it jumped, it went way up and real high, parabolic to work for. So interesting to see that with Intel. But Intel, Apple, I think Microsoft's an interesting company right now. They have a lot of leverage to pull. I don't think they've pulled. We've started to see those turn around. A lot of the cybersecurity companies definitely should be coming in to play right now. But this market has brought it out. And while people may think that's worrisome, it's actually a good sign for the market. If you don't want an AI bubble, if you don't want a bubble to bust, you can't just keep letting concentration get so high. So high, so high, so high. And where people worry about signs that we're looking for or what people are looking for with the AI bubble, how is this being serviced? How is it impacting free cash flow from the corporations who are using this capital expenditure? Like, where are they taking away their money that they have after their sales to fund this? Like I said, the free cash flow, or are they going out and using debt to get it? Which once again, issuing out and paying people back money, so that's some of their cash flow as well. Or are they even issuing equity? I think part of the call last week was part of the problem with Google, because Google's stock went down, was they said they were issuing more equity at the market rate. So that was then to fund their AI build out. So that was an issue. We saw Google really crash last week, like just stumble and go down. So yeah, Intel, like I said, 20 to 100, it's just corporate realignment. What we're seeing right now with like Apple, Intel, all these tech stocks, I think right now is a re-rating of these stocks. The whole sector actually, especially when like inside the semiconductors. So what we're saying is you see those re-rate, you see they'll move lower, multiples, all those things are readjusted, that to where their actual earnings are. It actually makes some of these stocks cheaper when you look at them, like the price tag may be higher, price tag may be lower. Sometimes it makes them higher too. But yeah, it gets back, this re-rating and this market adjustment right now is definitely, whether you can feel it right now as healthy or not, is healthy, right? One more thing to think about with the Intel, right? So if you bought Intel down here at the $20, or Intel was like $12 not long before that, and you had a bunch of it because it was so quote unquote cheap. When I say cheap, that's really not what makes it cheap. Like even right now, Intel's price at $100 some odd, it's not cheap because their earnings aren't, they're, I think before this last report, they were like 100 times. So it's like $1 per share was 100 times the earnings. It was crazy. It was bad. But that numbers probably came down now since the last earnings call. But what was saying, so like cheap, but if you had this stock at $20 and it went all the way up to $100, it's probably prudent to, I'm not saying sell it all, but probably trim some positions, especially if you had over like a year. So now you're looking at long-term capital gains or short-term capital gains. So if you had Intel that long for like over a year, it's probably prudent to look at Intel and trimming some of it, taking some gains, because you never take a loss locking in gains. Let's get that one more time. You never take a loss locking in gains. So anytime you have a profit, a stock or whatever, you're never taking a loss if you're locking in those gains, right? And you only take a loss when you sell if you sell if it's down, right? Otherwise, these are all just paper losses. Another thing with the Intel thing is like, is this in a taxable account? Or are you paying taxes on it like now, or is it in a non-taxable account, like a pre-tax account of some sort, which make a difference with how much you trim or how you adjust your Intel allocations as well. Because like I said, with capital gains, short-term versus long-term holdings, if it's in a taxable account, and then with Intel with that type of gain, I think a lot of people learn about that with the meme stock move that we had, GameStop, and then with Bitcoin and crypto, just how much it moved and people were selling them so quick and they didn't realize that they were about to pay, whatever you may pay in taxes, 40% at the end of the day, state, local, federal. Once you pay out all your taxes, you just never know what may come out to when people aren't accounting for that when they're getting that money on the front side. So if you're trimming, just make sure you know that while you're trimming, have a reasonable position. You don't want any of this stuff oversized. I think that's what we literally just saw right now or here recently, is that when you oversize your market or you oversize positions, it can make big gains, but it can also hit you with big losses and swings back to the other side. So we're seeing these things happen right now. Another thing, you don't have to chase these stocks, right? You don't have to chase some of these stocks at all-time highs. Sometimes it's good to buy a stock at all-time high because it might still be going up. But like Intel right now, like I said, it was $120 just a few weeks ago. Now it's down in the 90s to $100 range. Like I said, these things are re-rating and trying to figure out where their floor is, where their footing is. It's probably not $20 again, but maybe it's not $120 again. So somewhere in between that range, you can figure out where it is. You don't have to buy it at the top end of that range. Same thing with Apple. Apple just hit all-time highs, but Apple, if you're buying these stocks to hold, like investments, like long-term holdings, you never know. Once again, not recommendations, just, these are what we have. This is what the world's looking at right now in this more economy. So, just some of those other ones. Then we saw, I guess I would be remiss not to talk about SpaceX just a little bit. SpaceX, and they had that IPO came out, the stocks lost a lot of value since then, or the stock prices come down a lot since then. They report next month, and then they have an actual place where they can, some of these options, some of the lockups come out. So we can see a lot more volatility in these stocks in between now and then. If the SpaceX in between now and then, it could go lower. It's trading, I think it was like under 120 today. Could it go under 100? Could it go to 80? Like 80 is like half of where it came out at the IPO price. The IPO was like 135, but the first trade was like 160. So that's why I considered it. But could it go to that number? Yeah, absolutely could. You have to look at these companies and stuff like that. So as I said before, if you're investing in a company like SpaceX, you have to know the volatility that's inside there, right? You have to know this company can go way up or go way down. And then it's somewhat tied to Tesla. That was part of the thesis when people were buying it to begin. Now, SpaceX going to buy Tesla real quick. And what actually happened is like in that first day or a couple days, they got enough market cap gain and they did actually buy another company. SpaceX did actually acquire another company, all cash, pretty much the amount that went up in the stock. So they made acquisition, but they don't have enough market cap value to buy Tesla right now. They don't have enough quote unquote money to actually buy Tesla. Maybe they're going to do some of the GameStop stuff, GameStop, eBay, half cash, half stock, and then just let you figure it out. But once again, Ryan Cohen may be playing chess over there at GameStop. I digress. I lose and go back. But once again, that's just kind of where we're at right now. We talked about the Fed, Kevin Warsh coming up. We got the economic data. We just got back behind. We have to see if the Fed is going to look more at the inflation side or the employment side. What's going to push the chairman one way or the other? Actually, a board. There are so many other people on that board that one person can't determine what it's going to be, what the rate is. So you have multiple people on there for a reason. So you can get a quote unquote balanced outlook and representation for the whole country, because these governors are all from over the country. So hopefully they're out there listening to the people, and following data is needed. But, Kevin Warsh is a new chair and he's going to approach things in a different way. So we'll see what you do, Chairman Warsh. But his meeting's next week. Then, like we say, we have Iran and energy impacting inflation, right? So it can make it higher. When it came back down, we saw inflationary pressures that were lower. Even when you strip out the core, we still saw inflation that was higher. And then we saw inflation that was dramatically low. So inflation is all over the place. They haven't quite figured out where it's at, what we're going to do with this inflation, probably holding steady. Talked about Apple, the Apple victory lap. I don't want to say victory lap, just Apple home back. Just it was more to let people know, like, and this isn't even just like for me, it's like people in general, you have to, there's great information out there and it's not all coming from mainstream media, right? Some of that stuff is slanted, tilted, and some of them have different objectives than to just bring pure mainstream information, right? So that's why I like to sit back and talk about markets. I could talk about those all day long, markets and this and that. But we're going to do a little bit of the, educational stuff that I like to do as well. So we'll talk a little bit about the 401ks, as I promised, so the main bit, how this is how, Americans, right? Like I said, they're not coming to save us. The government's not coming to save us, right? If you think the government's coming to save you, come on. We're tripping. We're tripping. We're tripping. Come on. So let's set the stage, right? Like I said, someone asked me this about the 401k and just talking about that. They saw something that was very interesting. It is interesting, if you've never like went through the history of thought and realized like how we come about this level of retirement, why we have 401ks now when we had pensions before. One of the things so let's anchor this all to think about this. Anytime the government eventually offers some type of entitlement or incentive, so 401ks are tax advantage accounts, right? They can provide tax advantages for your employer and they can provide tax advantages for you. Government only gives you tax advantages or tax benefits or things. Usually if there's some type of like long-term benefit for the government. Government sees the long-term benefit if they give you these tax benefits and tax breaks. Obviously, you're going to pay the taxes one day on your pre-tax retirement. So that's just a loan to them. Once you retire and have to pay those taxes. Uncle Sam loves it when people retire and they haven't done any Roth conversions or planning any type of tax planning or make their portfolio proficient because they're giving him a great big check because people don't even usually think about it. They just take out that money and they don't even think about what it is. But it shifts the risk. It's basically what it's doing, right? So it's just basically shifting the risk. And anytime, like I said, anytime the government is offering a tax benefits because they feel like they're taking some kind of risk off of themselves and giving it to whoever else it is, right? So even before 401ks, like you have to realize there wasn't retirement plans, right? People grew up when there weren't a lot of books printed, a lot of things in the world, and quality of life. So people's quality of life expectancy, like even into like, the last century, people did not have high life expectancy. I think it was like 47, 50 years old that people were expected to live. So you would pretty much work until you died. And then if you worked until you died or you didn't work until you died, you work until you were old and decrepit, and then people would have to take care of you. I guess it would be, your family or whoever is taking care of you at that point, or maybe the community, but you didn't have like a retirement account or 401ks. Some companies eventually, you have to go to what was like a literal poorhouse, right? So you would have to go to a literal poorhouse at this point, right? That's what they had. So like I said, before that 401k plans became things, people faced going into like literal poorhouses. Then they developed pensions. But what you got with the pensions were sometimes you would give the pensions where the people would sell a pension, pay them, and then pay into them. And then the company may not even pay the pension. The company may go out of business. The company may only be able to pay pennies on the dollar to the pension recipients once they reach a certain age. So let's go all the way back. Like I said, so at the beginning, the burden was completely on you people, right? To retire, take care of their retirement. But there was really, people didn't think about retirement. I don't even know how big a word retirement was. A lot of people read the Bible, like growing up back then, especially because there weren't so many books in print, and there's nothing mentioned about retirement in there. Some people just didn't think about retirement. People just worked until they died. Lifestyle changes, industrial revolution, these type of things made it where people were living longer. Massing technological advances made where people were living longer, like I said, and then the industrial revolution moved people from, because these people were living out on farms, right? Agriculture, producing all these things with large families that stayed mainly because they had to work. Like these families had to have, 8, 10 kids because these 8 or 10 kids had to work in the farm. You know what I'm saying? These are 7 days on when you work at a farm. You don't get to take off days like pigs or whatever you have on your farm they don't understand holidays or national, federal holidays or anything like that. So back then, like I said, the full scope of it was on individuals to retire. You have to take care of it, right? Then eventually the government and people realize like this is crazy that people working, people can't retire, people are living longer now. They have nothing set up for them. We got Social Security set up. Roosevelt might have Social Security. So back in the 40s when we started, that's when it really all kind of expanded, these type of plans. But you had Social Security, you had pensions before that. But Social Security was a system where we all think about now today, where you pay into Social Security, but it was much different back then. It was the same basis, but it was much more limited to people. I think you got like $20, $25 a month if you were getting Social Security when it first came out. Social Security was also a system that was set up from the beginning where like some of the first people who received money from Social Security had not paid enough money into Social Security to start receiving money back really for the rate they were getting. So Social Security kind of started, down from downtrodden, maybe as you want to say, starting at deficit, kind of is how Social Security began. But Social Security, so you have that built in to kind of help people, but that also didn't have health care for people once they retire. You didn't have Medicare, Medicaid, all that stuff built into that. Those came in separate acts later on, somewhere around when the 401k came. Anyway, so we go from the people funding their own retirement. Then you have pensions for certain companies when people reach certain ages and they've worked a certain amount of years and they've paid into the company. Company would say, okay, we're going to annuitize this to you for the rest of your life or however long you live. Pensions, back to the simple, like I said, we have the people who are agricultural out there and then people would end up in the poorhouse, like a literal poorhouse is where you would end up if you didn't have anything set up for you to retire. You go there. 1900, I think it said 47 years old was life expectancy. So people on the farms, growing up in the farms and literal poorhouses, right? There's just public institutions ran by the local government. It's just absolutely and utterly, we don't think about these things, when we're growing here the term poorhouse, but these things come from somewhere else. Like I said, in like the late 1800s, American Express was one of the first people who created like a corporate private pension. And then over the next few decades, other companies followed. So U.S. Steel, AT&T, Goodyear, these companies followed. Then the Great Depression hit, stock market crash, 9,000 banks failed. And that's when you start to see some of the deficiencies right there. And you saw Americans didn't have anything set up, right, for retirement and funding. So that's when they came up, Social Security Act, which was, supposed to be a three-legged stool. Initially, how it came out. Social Security is going to be one, so that's the government part. Employee pensions, that was going to be a corporate part. And then personal savings. People were saving, right? So they're individuals. So you got three legs to your stool, and that should set you up where you can retire. That was the thing. But like I said, we had companies where they were just not doing it. Some did. Some people were doing ceremonies, giving out gold watches. And then we had a company like Studebakers, which was bleeding money, and they just was taking the pension fund. It was underfunded, and then they eventually just didn't pay their people. Some of them actually got it because they got annuitized before this company didn't get to a level where they could pay it. But most of them either got nothing or they just got like penny on the dollar. So that's just terrible, Then 1978. So 1978. So all this is before 1978. There's no 401k. They create a code, 401k, a tax code. And it's actually section 4, it's actually 401, like section K in this code. That's why it's a 401k. The government people are just, just say how it is. But that's the tax code in 1978. And this was for compensating executives at the time, right? So this was for compensating like executives. People didn't even realize that these were for like employees, But once again, all this is about where the risk is being shifted. We're shifting the risk back to the workers or we're shifting risk back to the employees, right? Let me take another step back with this. So a defined benefit plan, right? And deferred benefit plan, right? So one, here you have the defined benefit, pay into it, you're going to get this at the end of the day. That's more of the corporation taking the brunt of it, the burden. And that's what they did not want to do, They wanted to make it where you pay into your own plan. And if you retire, it's more your hands, Anyway, so the 401k was originally created for executives, but then they saw like a loophole in there, and they realized that the 401k was actually set up where you could use it for any employee. And there was a gentleman who decided he was going to do that, and he took it to a client, and the client didn't want to do it. So he actually started with his own business first. I think in like the early 80s, because there was just a little section there that said that you could defer the plan back to the employees. So once they realized that part was in there, like I say, he realized that you could do that, and the company started doing it. Ted Biena, so pretty much created that once he realized that and started doing it for his own company. So you had the 401k, then they kind of not codified it, but they went in and kind of gave it more regulations and guidelines in 1982. So as we see this increase into the 401k, we see pensions start to fade away, right? It's rare that you find someone with a pension nowadays, especially like someone younger, jobs that offer pensions. There are still some out there, but it's just a rare thing that you see right now, right? So then you see people going to a 401k. What are some of the benefits of 401ks, right? 401ks, so like we said, some of these are, depending on what your tax as is, pre-tax, they can help with your tax bill, but it's just deferred tax. The employee match is a big part of it, right? So if your employer is matching you, that's essentially quote unquote free money, whether it's vested or not. Hopefully it's vested. Hopefully it matches vested. I think I saw a post out there where someone said the match vested in staunches. And I've seen that before in employee plans where your match vests like over a year, 2 years, by like 4 years, you got the full match, all that stuff's back in there. But if you leave before that, you don't get that. And that was one of the big things with 401ks too, 401k plans as well. Like a lot of these type of flexibility, depending on the plan, depending on who it's set up for. So just a lot of it's interesting that this 401k plan was set up pretty much, like I said, by accident. And then the gentleman realized that there was a loophole in there where you can actually make it more beneficial. And then, of course, Wall Street took advantage of it. Well, I won't say took advantage of Wall Street, definitely went there and checked it out. Wall Street went in there and built funds, mutual funds and index funds put inside of 401ks that they can sell to people. Once again, like I said, it's really just, and it goes back to the risk transfer, right? So Wall Street didn't just create 401ks, engineered the greatest risk transfer in American history, one of them, right? But before 78, employers, they burned the button, guaranteed pensions, steady payouts, when they met these things, corporate responsibility. But after that single tax code accident, loophole, that burden shifted, entirely on us, right? And now we have like 60 million Americans in their retirement, that they can't control. Fees you don't see and outcomes nobody can promise, right? Because even if you put all the money you were supposed to into a 401k, it comes out like what, 23.5, 24.5 a year if you're under a certain age, but not at the catch-up age when it goes up to right around $30,500 a year, right? But if you start late or that might not be enough, so you have to find other avenues and ways to say that three-legged stool. Don't count on Social Security now. That's not to say like Social Security being solvent, but if you can plan your retirement without Social Security and you have like the means to do it, that will be that's really a plus if you can do it without the Social Security. Like I said, yeah, so they just moved the risk back to the people, right? So it went from the risk that was completely on them to completely on us, right? So, like I said, nearly half of Americans 55 and over have no retirement savings. Yeah, I sat back on that one for a minute. So let's think about that. Half of Americans 55 and over have no retirement savings. People think that Social Security is going to save them. Social Security is not meant to fund your full retirement. It's a supplement to your retirement, if anything. It actually was built as a supplement to your retirement, right? We just saw the three-legged stool that we talked about earlier, but it's collapsed and now it's just like a single leg for people who, and one-legged stools don't work, That's a pogo stick with a seat on the top. That ain't going to work well for you. It's not going to work. So if you do have some type of 401k or some type of employee match plan, make sure you're getting it all the way up to the 100% of that match if you can, right? Never leave that on the table. Never leave that on the table. Check the fees that you're paying aside at. So many people, and this was a LinkedIn poll actually did, so many people don't realize that they're paying fees inside their 401k. They think their 401ks have zero fees. They're not paying anyone to manage it, and even if you're not paying someone to manage it, your company's paying someone to manage it. Like, it may be a small fee, but it's a small fee. Check inside the actual funds that are in there. Most 401k plans now are like mutual funds. So if you look inside there, make sure the expense ratio is not too high because they're definitely low cost ETFs, 0.03%, 0.06%, for these basis points. And then you see some of these other funds are, 0.5%, 0.75% expense ratio. That's too high. See if you can find something lower than that for your expense ratio for the investment of the actual fund that you're in there. You can't rely on a single account, right? So Main Street, I'm trying to give us all some actionable steps. We can't rely on one single account, and it can all be like pre-tax or after-tax money. We can't rely on one single account. I keep saying this. The three-legged stool is a real thing, right? How many legs you can have on a stool, right? So the way it was set up, and everyone has different variations on this now, but you want to have multiple income streams, especially in retirement. Especially once you stop working and like earning income, you will have ways to grow income. I think it was John Hope Bryant, he said, you work in the day to earn your living and then your money works at night to grow your wealth. And I'm paraphrasing and butchering that all at the same time. But it's the intent that you work and grow and then your investments work for you, right? You let your money work. We hate lazy dollars that are not doing things for people here. So different kind of accounts help with the tax. They help with the growth. Peter Thiel, he's going to be a Roth billionaire, I believe. He started his Roth conversions like right when it became a thing inside his IRA, investment retirement account. And they were so cheap, like the stock that he had bought, and now it's appreciated so much. And he's going to be at the age where he can access this without a penalty or without a fee. I think it's come up to like $1 billion. Like, so a Roth billionaire, so tax-free withdrawals on that type of money is absolutely nuts and ridiculous, But yeah, and that's the technical term, nuts and ridiculous, right? But so track, and then you need to track your household budget. Make sure that we're looking to see how much we have as our household budget. Check out Money Out Money for that. For those anyone who is looking for a new budgeting tool, I have a link in the description for you. Money Out Money's one I use an affiliate link. So if you do decide to use my Monarch Money, I may be compensated at no cost to you, no extra cost to you. But they have a free trial going on, so you should check it out. Link will be in the description. Same thing if you want to check out some of this market news. I know we're going back when we were talking about things earlier, but Benzinga Pro, I've got affiliate link with Benzinga Pro. Some great stuff with Benzinga out there. So we just talk about how Benzinga's on top of it. So go in there and check that out. They have a link where you can start using them as well. So Benzinga and Monarch Money are some cool people helping Main Street folks. They're helping us down here on Main Street, to grow into Wall Street. So it's good stuff. So like I was saying, so the risk has been shifted, right? So now here we are with 401ks, pretty much pensions are gone. And that has gone back into the portion where the risk has been shifted all the way back to us. The risk has been shifted back to working Americans and completely away from the government or the actual corporation to make sure that people, who work there for 1,000 years are actually compensated and taken care of. Now, once again, I want you to understand, the collapse of the traditional pension plan ruined retirement for millions of Americans. And you got to understand, like, the institutional difference between a defined benefit plan, defined contribution plan. So when I talk about the risk shift, right? So I said it briefly earlier, defined benefit plan, that's that promised outcome, right? So you put money in here, right? You continue to put money in this pension, defined benefit is up there. Your employer say you work 30 years for us. Based on your final salary, we promise to pay you, I don't know, let's say $5,000 every single month until the day you die. Company has to hire, Wall Street managers, whoever invests capital, make sure they make that money is there for you. If stock market crashes and the corporation has a problem, right? Not you. Defined benefit. As long as you do what you say on that part, as long as you put it in there, they're going to give you that benefit. That is defined, right? So the defined benefit for. But the shift now is defined contribution. So it's a promised input. Like in the 401k, the only thing defined is the contribution, right? Like there's no guaranteed result if you go in there and make bad investments or if you don't know what you're doing, right? Your employer can say to you, this is what you should put in there. Maybe it's 5%, 10%, 20, whatever they tell you, and we'll match whatever. But some people won't even match your whole percent. So yeah, you may have to put in like 6% to get a 3% match or 5% to get a 3%, or whatever you have to put in there to get that full match, right? And then it's like, good luck. You know what I'm saying? Figure it out. I'm like, what? Okay, interesting, so it's not the same. So there you go. You're defining your contribution as long as you're contributing into it, then but there's no benefit that's defined at the end. So you don't know what you're going to get at the end. Hopefully you invest in it wisely, and it grows, which, stock market and investing usually over time, proper investing will grow. But like I said, Wall Street rebellion shift, as freedom and personal control, but once again, what it really did was it really took that personal corporate liability and just put it right back on people, right? Took the burden out from market volatility, inflation, bad investment picks, off corporate balance sheets and dumped it squarely back into Main Street, right? Back into our lap. So that's why Main Street, we need to be investing. That's why when you invest inside your 401ks or whatever your retirement account is, you need to leave that money invested in there as long as possible. Don't go ahead and take that money out. That money's for later in life, right? So if you're investing inside those accounts, your retirement accounts, your 401k accounts, your IRA, whatever kind of 403b, 457b, there's so many different accounts. Now you have the Trump Kid accounts where you can invest for your children. Got a couple good videos on those already up on the channel. Check those out. Be sure to check those out. But if you have those, right, that is just, you want to contribute to them to the level that you can. You want to contribute to a level that makes sense economically as well. 401k. So some of the questions people ask about 401ks, right? So should I roll over my old 401k from a previous job into an IRA, or should I leave where it's at? What can I do with old 401k? That's a question. What you can do with old 401k. So, and generally there are just kind of usually three things you can do with it, right? So you can leave it at the old place where it's at. Just leave it there. Unless sometimes they make you move it if there's not a certain amount in there, if you've left it there too long. You can roll it straight. You can roll it directly into your new employer. If your new employer has a 401k or retirement investment account benefit plan for you, you can roll it straight into there. And if you do it, if it's a pre-tax account, you do a pre-tax to pre-tax, there will be no tax implication, will be no tax penalty or anything inside there. So you can roll it over, or you can take it and roll it straight into an IRA, individual individual retirement account. So you can do that. And once again, if it's still the same tax status, you're not going to pay taxes on that at all. So long as you keep it pre-tax or pre-tax, or if it's after tax to after tax. You don't want to go after tax or pre-tax, but people, you'll be surprised what people do sometimes. Tax status is important, right? And so you want to make sure if you're moving it, you're going to move it to the same tax status as it was before. Unless you're planning, maybe you're a young person, maybe you're Peter Thiel, and you're in your early years of working, and you've been at a job, and you've earned the least amount of money you've earned, and maybe now it's the time to convert that money over to Roth. Or you're working and you've got laid off, and it's going to be like your lowest income year that you would have in a while. Maybe that'll be a time to go ahead and take that 401k and roll it over to Roth. Once again, not investment advice, because everyone's individual experience is different. Everyone's individual goals are different. So you just can't make blanket recommendations. Watch out for people who just make blanket recommendations. People are just telling you, you just do this, you do that. They always leave out a couple steps, and especially on the tax side. That's where you generally get people. So that's what you can do with that 401k. Roll it into either your new workplace benefit plan, to a different type of retirement account, hopefully with the same tax status, so you're not paying taxes in both those situations. Or you can just leave it there if the people let you leave it there. Why would you roll it into an IRA or to a different tax account, or into a different workplace benefit account? Because you may have better investment options. Usually inside 401ks, that is definitely one thing that we see. There are limited options that you can invest in. Usually in 401ks, you have investment fees. They're higher fees because they're mutual funds. So what you have there also, like I said, so you may have, just look at it, if you can get into an IRA or something once you move jobs that offers lower fees. And now another good thing that we have inside of 401ks, we have the option they have what's called a broker link. So inside 401k now you have the broker link where you can go in there and actually go inside and invest different individual positions inside the 401k. So it doesn't even have to be the high feed index funds that we're used to inside it. 401ks. So those are some of the things that people can do with 401ks. So like I said, in most cases, and then the expense ratio, like, was too high. I think I kind of mentioned that earlier. You want to keep that thing, under 0.5%, definitely under 1%. You can find those things for like 300%, 3 basis points. So you can find some cheap stuff, right? As far as the go, but you make sure you're not paying more than 0.5%, 0.75% for basic index as well. You know what I'm saying? Because they're not really doing any managing in that thing. So look for a low cost broad market. Probably it's going to be an ETF. That's going to give you the best benefit for that. You can check out, got some videos on ETFs, how those things work, and mutual funds, because sometimes mutual funds do work, but mutual funds are, they're going to actually be taking your money out as well. But they're literally mutual funds. So those funds can't be taken out by some of the people who mutual use. Well, I guess it's their individual use, but they're coming from your mutual funds. It can create a taxable event. ETFs don't quite have those. So ETFs versus mutual funds it's a good video to check out on the channel, on this page, right? So ETF versus mutual funds. Then people may say, how does inflation impact my target retirement number, right? Because everyone always thinks, just get $1 million. And I say everyone's retirement number that's really an individual thing, right? Because some people can live off X amount of dollars a year. Some people can't live off X amount of dollars a year, right? $1 million today buys you a lot less than $1 million bought you 20 years ago. And the case will probably be that $1 million today will buy you a lot less than $1 million will buy you 20 years from now. So you have to think about that when you're investing. Same thing goes for $1, $100, 500, whatever your dollars are. The purchasing power, we've seen purchasing power shrink dramatically here over the last few decades. So individual purchasing power, I should say. We've seen pricing power on the other side by producers grow. So the ball's in their court. But inflation pretty much erodes purchasing power, like I said. So that $20 million is going to be the same. And then even if you want to keep it all in cash, and you're like, I'm keeping up with, not all in cash, you don't want to keep it all in cash. But let's say you're keeping it in cash. Cash always loses to inflation. Cash going to lose to inflation because even if it's sitting in like I say, a money market account or something that's a high yield savings account, something that earns interest, it's based on the Fed fund rate, and the bank's still making money. Bank's always going to make money, right? It's just no matter how much or how little, but banks are always going to make money. As long as they don't do anything like crazy and get over leveraged, banks should make money. But we see when they create crazy things and get over leveraged, we see financial system crashes like 2008, housing market crashes. That was just, that was a conflagration of things. And we saw it really led to a fireball, just terrible, terrible experience for our Main Street. That's what we saw. But yeah, so inflation really decreases purchasing power. So unless wages are keeping up, your wage growth. So if wage, that won't impact $1 million versus being $1 million, still $1 million. But that can help you at the saving rate where you can increase. So you just need to figure out what it is. A lot of people are like, $1 million, I'll be set. Maybe you will, maybe you won't. And some people may be set, $500,000, $200,000. You just never know. It's such an individual thing for everyone, for you, for yourself, how you want to go about it. So however you want to do it. So yeah, I think we've talked a lot. I'm trying to think if there's anything else about the 401ks or this market that we're seeing right now. I mean, it's just, there's a lot going on in the world. If you don't have a retirement account, you need to set something up of some sort. It's never too late to start. If you're over a certain age and you don't have a retirement account, maybe you should just go ahead and set it up as a Roth, right? Don't even worry about that pre-tax benefit. Go ahead and get that money in there now where you can get it tax-free later in life. The chances are, if you don't have a retirement account set up already, you're probably not ready to retire. If you're a person like of a retirement age, old enough to get the full benefit of the Roth. But you want to have these type of things set up in place. You want to have these things ready to go for the world. Just what's happening. Woo! Yeah, we've covered a lot of stuff here today. We sat here, we've had massive, just long conversations, a good conversation, but it's been a long conversation. It's been a while since I've just sat and vented and talked to you all Main Street. Like I said, Main Street, I really appreciate you all listening. You all are just, y'all fuel me, fuel to the fire. People out here, I mentioned the podcast, and that is global. Like, I mean, it's global, like seriously, like the amount of people who listen in different countries where they're listening from. It's really cool to see. It's really cool to see the growth. I love when people send me in questions. I love answering them when I can. Like the 401k dive we went to, I could probably go even deeper into that. We're already a little over this one with the market cap. I could do a whole video just on 401ks. So y'all let me know on retirement accounts or why they were set up or why they're, y'all let me know what you want to hear, Main Street. Let me know some of the questions you have. The podcast, like I said, the podcast is over 50 some odd episodes deep. So that's a beautiful thing, full of individuals and great information. A lot of interviews. We want to cover the whole spectrum with the podcast. For those who don't know, we're trying to reach a lot of people. I want people to see, to hear. I want to help financial literacy be spread out across the world for people who don't know about it, people who get to see it. I do actually want to take a second here and I want to show you. So yeah, I want to show you, I tell you, this is a global community and I really do appreciate everyone looking, everyone listening. I appreciate everyone who tunes in, so the last few minutes, I just want to take and I want to show you all. I want to thank everyone, for tuning in. And I just want to show you, look at where people are watching from. So 55% from the US, 10% Austria, thanks Vietnam, Brazil, Jordan, Indonesia, Pakistan, Ecuador, Iraq, Colombia, the Philippines, Norway, Bangladesh, Jamaica, Russia, Brunei, France, Algeria, Kenya, the UK, United Arab, Congo, India, South Africa, Mexico, Angola, Costa Rica, Venezuela, Argentina, and the Toga. So anyone, everywhere, all you people, hey, thank you. Appreciate you tuning in. Appreciate you watching. These are real numbers. These are the real things. Like, you see them. Like, it's very humbling. I really do appreciate it. Let me know what topics you all want to hear. Let me know what you want me to talk about, what you want me to expand on. We have some great stuff going on that we actually just did with Ashley Kwame, where we're talking about financial psychology. Got some great stuff coming up, some great guests coming on. Like I said, the Main Street Meets Wall Street podcast is over 50 some odd episodes. The YouTube channel right now has, oh my goodness, it has a couple hundred videos, maybe. I don't know. You're counting the shorts. It has a lot of videos. So there's a lot of information over there for folks who want to get the information. Like, it's there if you want to hear it, if you want to see it. There's a lot of information. I hope you share this with people. I hope you subscribe. I hope you let me know what some of the questions you have, some of the things that are, impacting your world. And yeah, Main Street, I just don't really know how to thank you enough. I really appreciate it. We got some live sessions coming up. If you haven't hit the subscribe button, hit that like and subscribe button. Check out some of the links. Like I said, the Benzinga Pro, Monarch Money, subscribe to the Wall Street South Journal on LinkedIn. For those who don't know about the channel, the tempo of the channel, what we're doing. So every Tuesday night, you're pretty much going to get a podcast interview. I have a guest. It's good stuff. And we've covered so many things. Like, just go back and check out the podcast. I think we've covered pretty much encompassed the whole economy in some type of way. So if there's something we've missed, let me know so we can cover it in discussion. But we just finished up the Bitcoin discussion, right? Crypto discussion, where we had the bears and the bulls. So That's on the channel if you want to listen to it. The debt discussion, like I said earlier, we were talking about the debt. There's a lot of stuff that we go back and talk about the history of like just finances, Dow Jones, like to do history stuff. Then we have live sessions where we go live and talk about the market and what's happening right now, right then, where anyone can tune in and ask questions. That's a really good thing. We love going live over here. And yeah, check it out. We have a lot of stuff in print as well. People who are asking questions, journalists, so different places all around the world. We're recorded in media. You can find us on LinkedIn. You can find me on YouTube, Marcus Sturman Sr. Also, we have the Main Street Meets Wall Street podcast, which I'm talking about right now. I guess that's it, Main Street. Like, I'm pumped, man. So excited. It's been too long since I've been here. Always check the fees before you do anything. If you're looking for someone you don't understand like what they're offering you, probably say no till you can get them to explain it better. But one good question is to always ask someone like, so how do you get paid? That's a good question because that'll tell you a lot. But I got a video on that too, like whether it's fee versus commission. That just tells you where it's setting up. But that's a good question. If you can figure out how a person gets paid, you may be able to figure out like part of the way they get money. And if that person can't explain to you how they get paid, that's a big red flag right there. But once again, anyone listening, if you found any value in this conversation, hit the like button, share, subscribe. This is a good week. It's a beautiful day. Watch out for market turbulence. Once again, remember, it's only a loss if you sell. It's only a gain if you sell, right? Well, otherwise, it's just paper, losses, gains, and sales. Main Street, I really appreciate y'all. I've showed y'all the stats, right? Showed you that people are watching us globally. This is happening. Appreciate the support. Let us know if you need anything, Main Street. We'll be live soon. Check out the podcast episodes coming out. That tempo coming in. Yeah, oh yeah. And then like Saturdays or Sundays, somewhere over the weekend, we'll probably drop a video too every week. So you get a couple videos every week from this channel. Actually, I've been trying to pull back. I feel like I've put out like too much stuff too quick. So I don't want to inundate Main Street with it. But if you need more, let me know. Just tell me you want to hear some more stuff. And, we can get you some more stuff. But Main Street, Heart meets Wall Street Smarts. Hit the subscribe button, hit that like button. Tune in, check us out. Main Street, Heart meets Wall Street Smarts.